The Bank of Canada just raised interest rates by 50 basis points, or half a percentage, the largest single rate hike in the past 20 years in Canada. And this has some big impacts on a lot of parts of the Canadian economy. One, of course, is housing and real estate, right? When we see rising interest rates, we can often see lowered demand as a result of that because people can afford less on their mortgages. But we had the press conference here that we've just watched live on stream that we're recapping now, that gives us a lot of information on what the Bank of Canada is currently thinking, why they're raising rates, and why they think it's an appropriate time to do so. So he started off his press conference saying that the economy is fully recovered from the COVID pandemic. We're actually in a better place economically than we were before the pandemic, says Tiff Macklem, the governor of the Bank of Canada. But he says, hey, inflation is bad. And actually, we were wrong. We were wrong about inflation. Well, we thought that this would be transitory, right? If you were following the channel about 6 months ago, all the Bank of Canada was saying is inflation will be transitory. We're going to transition out of this inflationary period and get back to normal. And all of these inflationary pressures are just very short-lived. Here, Tiff Macklem saying, we were wrong. Our inflation expectations are actually going to be higher for longer. And he also brings up points about how, even with high inflation rates largely due to global macro conditions, right, seeing the war in Ukraine and the Russia conflict there, he says there are some sort of positives in the short term that we're making more as a country with elevated prices of oil with so much of the oil industry in Canada actually benefiting from these higher prices. But he emphasizes that their primary focus is inflation and that they're aware of just how bad it's gotten. And although there are these sort of foreign influences that are causing high inflation, they actually admit here for one of the first times that there are inflationary pressures that are happening at home. Now, the Liberal government has largely been saying, well, inflationary pressures are a global phenomenon. We're not just seeing them here, which is true, but interesting here that we have sort of an admission that there are Canada-based inflationary pressures that are pushing inflation up as well. It talks about how CPI is at a three-decade high of 5.7, above what they expected, and they now expect that inflation number to be around 6% over the long term and not slow down until second half of 2023. So big changes here from what the Bank of Canada was saying previously, saying, okay, inflation rates are going to be high, and they say very, very sternly, we're aware of this. We've raised interest rates now once, and we're planning on raising these interest rates even more aggressively, and we won't hesitate to do this dramatically. So there's a little bit of a reading between the lines that you have to do here. The Bank of Canada, of course, is always worried about inflationary, inflation expectations. Now, what they say what they mean when they say inflationary expectations is that, hey, yes, it matters what we do, but it also matters what we make Canadians think, right? Because so much of inflation is a result of consumer behavior, right? More people wanting to spend more money. Now, the Bank of Canada is super scared and super worried of Canadians starting to en masse believe that inflation will remain high, that the Bank of Canada doesn't have it under control, and that it won't come back to 2 to 3%, right? Actually, it's 1 to 3% range. That's the band of comfortable interest rates that they want to hit. So the reason that this is such a big impact is if Canadians start to believe that inflation will be around long term, well, what does that mean? Well, individual Canadians say, hey, the dollars in my pocket today aren't going to be worth as much as the dollars in my pocket, or like these dollars today are going to be worth less tomorrow, right? That's inflation. So that could lead to more people going out, spending more money, and as a result, inflation sort of getting away from them. So by raising these interest rates, they're trying to put a damper on the economy, put a damper on spending, right? Because with higher interest rates, we have less borrowing, less spending in general, but what they're really trying to do is tamp down on inflationary expectations. So that's a big deal. Now, we got into some specifics. Right now, the overnight rate, which is what they raised today, is at 1%. They're saying you can expect raises over time leading to a 2 to 3% overnight rate. That's another 2 full percentage points from here. So they're forecasting increased hikes over time, and they say we could actually end up going over over that for a period of time. Now, the interesting thing, and this is not what he said, this is what I've sort of been thinking about, is that, well, like how far can the Bank of Canada go before they break something in the economy? We have incredibly high levels of household indebtedness, and when we have these higher interest rates, perhaps folks with variable rate mortgages or individuals who need to sort of redo or get their period on their mortgages sort of rolling over, well, they've got to pay these new higher rates. Does that have an impact in the economy? When we raise interest rates, do businesses borrow less? Do we start to see more unemployment? Right? These are the things that they're going to be looking at. But as soon as the Bank of Canada sees these sort of economic issues come up, well, what's the one tool that they have in their tool belt to sort of help against these negative economic implications? Well, it's to lower rates and to quantitative ease, print more money. Now, on the quantitative easing side of things, the Bank of Canada is forecasting that they're going to be doing more quantitative tightening. Now, if you followed my channel, you might be familiar with QE or quantitative easing. Essentially, this is when the Bank of Canada prints, like not actually at a money printer, but adds zeros on a computer database, prints money into the system. Now, they really do this through something called it's through credits that big banks can use to sort of settle up between each other, but ultimately that money does trickle into the system through those big banks' sort of lending requirements and capital reserve requirements. Essentially, you can think of it as like quantitative easing, more money put into the system, and sort of as a result devaluing the economy, but the Canadian dollar. But as a result, we have sort of lower interest rates when we're quantitative easing because the Bank of Canada is buying up all the Government of Canada bonds, lowering interest rates. Now, they're doing the opposite now with quantitative tightening. Now, they don't say that they're selling Government of Canada bonds, which would raise interest rates and lower bond prices, but they do say that they're going to let bonds roll off of their balance sheet, right? This is something that we've expected from the Bank of Canada, but they say that they're going to continue doing this, but not necessarily that they need to sort of sell things off aggressively. They're just going to let sort of these the maturity on these bonds sort of expire and not repurchase them. So that's a big point. Now, we got into a couple questions as well from the reporters in the room. One sort of brought up Pierre Poilievre saying that the Bank of Canada works in tandem with the government, and saying that the fiscal and monetary policy, like the quantitative easing, is a big part of why we're seeing high inflation rates right now. Now, he's sort of the governor of the Bank of Canada, Tiff Macklem, kind of steps around this question saying, well, we're just trying to maintain or try to get back to our 2% inflation rate. We see a lot of these pressures from the Ukrainian and Russia conflict. It's not really entirely our fault. So we see a little bit of contradiction here with the difference between Bank of Canada saying, well, these are global issues, but also acknowledging that there are issues here at home as well. So sort of talks around that point, but lots of reporters here are taking issue with the Conservative lawmakers that are saying, you've printed money and you've backed up the government's plans, so what's really going on here? They also talk a little bit about housing activity and what the Bank of Canada believes will happen in housing. The deputy governor of the Bank of Canada, Carol Wilkinson, I believe, who was also on this press conference, said that our expectation is that housing activity will moderate as a result of interest rate changes, but we don't think that this will have a drag on the economy. So they say that they expect a slowdown in housing for it to not be as fast. I'd say that we're already starting to see this. You might not know that I work in the real estate industry in the Greater Toronto area, and I'm seeing less competition on listings than usual. So that's interesting. But the one point that she makes here is that we're going to keep a close eye on this, but we don't think that there's going to be a drag on the economy. But they agree that elevated housing debt can make the economy more vulnerable. So they're saying they're keeping a close eye on this. Now, they have to weigh the pros and cons of sort of supporting the housing space, right? If we see something traumatic happen to housing, well, that's not that great for the Canadian economy. When we have sort of a crash in housing prices, less people are able to access equity in their homes to take out personal lines of credit, and sort of spend in the economy. This could be bad for local businesses as well. But that's kind of what they're going for here, is less spending. They want to see people be more conservative with their finances so that we don't see sort of rampant inflation continue. So you can sort of get to see like the different levers that are being pulled here, and what the Bank of Canada is really going for here. But in short, we see this 50 basis point rise today, and they're signaling that we're going to keep doing this and try to fight inflation, but how far they'll go and how far they're actually trying to make us think they'll go, those are two different things. But we could certainly see rising interest rates for the next year here until the back half of 2023 when they say, hey, we think inflation is going to be sorted out. So for people just watching this recap that I'm putting on the channel after the stream, hopefully that gives you a better idea of what happened. You can watch the whole entire interview on the replay of the stream, which is also on the channel. But hopefully this video helped you out, and I'll see you next time.